12/14/2013, December 14th, Saturday, 11:01 a.m. Pacific Standard Time. And we're working with the S&P 500 weekly chart. Once again, it's been a great year for the bulls. There's no doubt about it. But here's the thing. Why is 2014 going to be different than 2013? We already know why. And why is it that on a percent level gain in the S&P 500, it's had one of its best calendar years in a very, very long time? But why is it that the trend for 2014 is not going to be nearly exuberant as 2013? One of the things that we'll say is that we put in another new 52-week all-time high on that S&P. We're going into the calendar year, the end of it. And the blue line is what we refer to as a 10-week simple moving average. And we're sitting on it right now. Now, various other times that when we got to this 10-week moving average, we rallied back up when we pulled back. Let us not forget, though, that the S&P 500 made an all-time high there of 1813.55, and the low of this weekly price range was 1772, and we close at 1775. What we will tell people is that the easy money's been made. There's a lot to be happy about for the bulls, and their bears are not so happy. However, that we can see that the 20-week moving average on the S&P is at we'll just tell you the number here, it's at 1725. It's down here. One of the things that we're clearly going to be monitoring on Monday through Friday, it is the last calendar monthly options expiration. That means that we are once again in an overbought area where corrections will happen, pullbacks happen. So if we break this 10-week simple moving average, we're going to print right through it. And let us not forget about the short interest in the tape within the broader S&P 500. There's 500 stocks in the S&P 500. What happened in calendar 2013 is that 400 of the actual 500 S&P names are up double digits on the calendar year, because they are. So when you take a look that 400 equity names in the S&P 500 are up double digits, is that trend for 2014 is not sustainable. You're not going to see the same move in the S&P. Yes, you are going to have trading ranges. The price volatility will increase substantially as we move into the first trading day of January 2014. We're going to see where there's going to be a lot of bear moves, there's going to be a lot of bull moves, but that we're going to get equally weighted between the bear and the bull. One of the things I'm going to be very clear of, for those parties that are looking for trading capital in 2014 and you want to join us, fill out the form. Go over here to the trading tab, click on free trial. Read what's on the free trial page. It's very self-explanatory. Get started. If you're looking for trading capital in 2014, for those people that have been on the sideline, this is okay too. Go through here, open an account, read the contracts, click getting started right here today. Listen, takes money to make money. We're not only here to train you, but we're also here to provide the trading account, enough money to make money. It takes money to make money. So once again, when we're going to move over here on the daily S&P 500, we're going to be very clear that this is a daily top. I'm going to draw a support line. It's right above the white line. That's the 50-day simple moving average. This is where we had broke out to these tops. This is what we call a short-term top, where that S&P 500 could not make a higher high, and that the 50-day simple moving moving average has acted as a long-term support level. And when we take a look at the broader trend cycles here, is that the 100-week moving average is this yellow line here. And it's been rising throughout 2013. And one of the things is the white line is the 50-day simple moving average right here. One of the things from this perspective is that the price volatility is going to increase. What do I mean by the statement? It's very simple. The bull has had it too easy, period. And after a big yearly move, you start to see where the price volatility gets big, meaning that yes, the volatility increases for the downside of the market, and then the opposite side of that is the bull side of that. So in both directional price movements, both the bear and the bull are going to have more of an equal weighted volatility. Now, because people are very complacent as they are, this is where part of these support levels are going to be. So if we break that white line, that 50-day moving average, the next major support level goes right over here where we broke up above this resistance level in 2013 and consolidated, held that, made the all-time highs. Now, because there isn't a lot of shorts in the market, that short interest float per se is at very low levels, meaning that the buy to cover is a very big minority. So the people that are short, that crowd, there isn't that many short sellers in this market right now. So remember that stocks and get support and equities have a way of trading in ranges because short sellers always have to buy to cover, and that's not in the tape. The margin debt that's out here, people that buy on margin, is at all-time highs. The bull and bear percent index is very imbalanced, meaning that you have 3 times the bulls versus the bears. And major volatility starts to happen at these kinds of levels. So as we enter calendar 2014, we'll know exactly how to put these trades on. But listen here, the S&P broke between the 10 and the 20-day moving average up here, as it did. It's got a support level here, and that's going to be the 50-day moving average. If we break through the 50-day moving average, we got major support level that at the lower level is going to be 1740, and it's going to be right over here in this video. It's going to be right here where we rallied up, took that out, and continued to go higher. And that the highs for the year are in. And that 2014 is going to be quite different than 2013, meaning that we're 5 years into this multiple expansion level. And the expansion started way back over here in 2009. And we've had a low that was put in February of 2009. And unlike any other great time is that equity prices run ahead of the economy, meaning that the economy doesn't really reflect these highs, because they don't. And the thing about it is, when interest rates go up higher and the tapering starts, that means that that bull side of the party is going to view that as a negative. Well, it's not really a negative. If short-term overnight money rates go higher, that is bullish for the economy. However, the separation between the two is that broader equities across the board in the S&P 500 have ran well ahead of a stronger economy. So when the economy does get better, a lot of people are going to sit there going, knock, knock, who's home? Why are stocks pulling back more when the economy is getting better? Well, I'm telling you why. I'm telling you that equity prices run in anticipation, and they run well ahead of the economic cycles. So 2013 was 1 year that the bull got a very, very good move. Remember, the bear started in year 2000, and it did. And it had the 2009 lows, and we're 5 years into the expansion. So there's going to be a lot of volatility in 2014. You better put your seatbelts on.